Fundamentals. Again, I can't give a full rundown of everything in this quick video, but just going to give you an oversight into how I approach fundamentals, because a lot of traders, they think that they need to become an analyst as well as a trader when they're two different jobs. You got an analyst, you got a trader. A trader's job is to have a plan and execute that plan. An analyst, it's their job to understand what new information has come to the market, whether that be data or some news, and establish why the market has moved and what are the potential outcomes of this new data. But the market's already done the move. An analyst can do all the prep work that it wants, but when you look at NFP, which happens to be tomorrow, the consensus there is 40k. Now that's taken from the averages of all of the estimates from the analysts at the major banks. Now you're going to have some that are saying 80k, you're going to have some that are going to say 0. So the data is going to come out and some of them are going to be right, but most of them are going to be wrong. So what is the point in trying to compete with these hugely intelligent people who are paid a lot of money by banks to do analysis when they're wrong most of the time? And anyway, the market makes its move instantly. So the things that you have to consider on a US interest rate decision, for example, you've got the rate decision itself. So if there's a change in the rate, well, the market will act accordingly. Remember, the consensus is already priced in, so if it differs from consensus, the market will then reprice. You've got the votes. So each Federal Reserve member casts a vote whether they want to cut, hold, or hike. Do they want to cut more than the others? The market takes this into account. Then there's the dot plot. Each Federal Reserve member will forecast where they see interest rates over the next 1, 2, 3 years and further. And then that's taken as an average and plotted on a chart, and the market will react to that. Then you've got the monetary policy statement. The wording in that will cause movement. The market will react to that. And now the algorithms pick up changes from one statement to another. So it'll compare it to last month's and it'll take trades automatically. And then you've got the press conference. So any questions, anything that Jerome Powell says will cause the market to move. So how can you take in all that information, digest it, understand it, and then take a trade when the market's already gone? It's made the move instantly. So the difference between a trader and analyst is that an analyst spends all the time looking at the possibilities, potential outcomes, assisting traders with their risk. Now, there's a way that you can risk manage without trying to understand all this information. Now, there's some accounts on X, formerly known as Twitter, as they say, that do all the work for you. There's people who are out there who are much more intelligent than me, who do this all the time, and they just post it on Twitter. You don't need any paid feeds, because you're never going to be able to profit from the information you get because the market has done the move already. So what we can do, though, to cover our backs and basically manage our risk. And by manage our risk, I mean a trader that is a fully systematic trader who's got a systematic approach that they take every setup that they see will just take the setup even if the market's volatile and prices rocketing towards it because the stock market's dropping. They'll still take that trade and take a loss. It's just part of their plan, it's part of their process. I don't like to take trades that I know are going to lose. But the trader that took the trade wasn't aware that it would lose because they don't understand the way the market moves. So the way I trade fundamentals is when some new information comes to the market. So there's 3 ways that the market can move. There's data from the economic calendar. There's either a tweet or some new news or conflict or anything, and sentiment itself can move the market. So if one of these 3 scenarios happens, let's get some drawings up. It'll be easier to understand. If some new information comes to the market and it causes US stocks to drop and yields to rise, the US dollar will get stronger because people are coming out of stocks into dollar. The returns on yields, the yield on the bonds is increasing, so it's more beneficial to hold dollar. So there's 2 reasons why dollar becomes more attractive there. And this could be off the back of an interest rate decision. It could be off the back of NFP. There's so many extra layers to the dollar than there is to pound and all the other currencies. On a pound bit of data, if it's positive, we'll see a strong pound. If it's poor data, we'll see a weak pound. But data can drive US stock market. It can drive bonds and yields. In turn, it will then drive the dollar. But we can also see the market do this. Stock market go higher, yields go higher, and dollar go higher. Since the tariff situation come along, we started seeing this move, and I'd never seen it before. And I've been in the market for 10 years. And it was basically, if the tariff rhetoric from Trump caused uncertainty, you'd see a move against the US as a whole. So everything would go down. So it was basically a vote of little confidence in the US. But if some news came out that China and Trump had agreed a deal, then it was a bit of a confidence vote. So stocks went higher, yields went higher, dollar went higher. So what's that mean for currency traders? Well, it means that if you're getting a stronger dollar, you could be seeing weaker antipods. So cable could be down, so pound USD could be down. Pound Aussie could be going higher. Well, any technical setups that you've got are not going to stop. The price isn't going to stop until this main move's happened, until this main move stopped. So when stocks hits a level, or yields hit a level, depending on what's driving the market, because it could be a scenario where it's only stocks driving the market or it's only yields. And it's our job to establish what market conditions are and what is driving price. I know this might seem boring, but the stuff that traders ignore and don't want to learn because it seems too complex is the stuff that's going to keep you in the game longest. The technical analysis and all the pretty stuff, it's not going to do you any good at all. You've got to do the boring stuff. The content that new traders want to see is detrimental to their progress as a trader. So that's basically how I manage the fundamentals. So if some news comes out to the market, I don't care about trying to understand what it is and what has caused it and what are the potential outcomes, the possibilities. If that new news has caused the stock market to drop, I'm not going to take any setups on my currency pairs until US stocks hits a level. And then I'll take the trade on the currency pair. It sounds really complex, but it is pretty simple. And we will discuss that in the next video when we combine the both the technical analysis and the fundamental side of things to establish the basis of a strategy. And then if you join the community, then you'll be given the full pathway of how to develop your strategy through journaling, data collection, and then become a profitable trader. Some traders will only need a tweak. You could come into the community with your own strategy that is maybe break even, or you're just not seeing the consistency that you need. And as soon as you add a bit of this fundamental side to it, it can really flip your results on its head. So next video, we'll combine them both and things should become a little bit more clearer.